2026 is off to a rough start for India. In just the first week of year, India's foreign exchange reserves fell by $9.9 billion, the biggest weekly drop in 14 months, taking reserves down to about $552 billion. At the same time, Indian stock markets have taken a hit, wiping out $140 billion in investor wealth. Two signals, one message. Pressure is building. Start with currency. The rupee had already depreciated nearly 6% in 2025, becoming Asia's worst performing currency. Now in early 2026, it is weakening again. That is why the Reserve Bank of India is selling dollars to defend the rupee. And the pressure may not ease soon. Nomura and S&P Global Market Intelligence expect the rupee could slide toward 92 per dollar by March 2026. Now look at the markets. The Sensex and the Nifty have both fallen sharply in early January. Foreign investors are pulling money out. In 2025, foreign portfolio investors pulled out $18 billion from Indian markets, the highest annual outflow on record. And in just the first 9 days of 2026, they've already pulled out another $1.3 billion. Why? Because risk is rising, especially geopolitical risk. The US has imposed tariffs of up to 50% on Indian goods, partly linked to India's Russian oil purchases. And in the latest move, US President Donald Trump has backed a bipartisan bill proposing tariffs of up to 500% on imports from countries doing business with Russia. India is the second largest buyer of Russian crude after China. That puts India directly in focus. So what are we seeing is a convergence, a weaker rupee, falling reserves, a market sell-off, capital outflows, and rising geopolitical pressure. India may not be in crisis now, but 2026 has already begun as a stress test. And the question now is whether India can navigate this pressure without losing growth, stability, and investor confidence.